Hello again, and this is the video for partnerships. So there are at least four problems with partnerships. They're not real difficult, but you have to go through a process and you have to just pay attention to what you're doing. Partnership is something that's easy to organize. Sometimes different partners will donate capital, whereas you have another partner that is an expertise in the business. So to induce this expert, sometimes they will give this person a stake, even though this person um, doesn't or isn't contributing any capital. It would be kind of like being a silent partner, I guess, for the other partners. So here are some of the problems. Here is 14.1. And you can see here that John, Jeff, and Jane decided to engage in a real estate venture as a partnership. John invested 107,000 cash, and Jeff provided office equipment. It is carried on his books at 88.5. The partners agree that the equipment has a fair value of 118,000. And there's a 31,500 note payable remaining on the equipment to be assumed by the partnership. So partner has a capital account, and anything that affects this, okay, so for instance, John has invested $107,000. So he gets credit for $107,000 in his capital account. Anything that adds income to the business, whether it be the business income or whether it be other income that is passed along to the partner, such as capital gains, investment gains, interest expense, that will be a debit to his capital account. Anytime there's a loss or a partner takes money or property out of the partnership, that gets credited. So if a partner takes out all the money that they put into the capital account, then that basically will reduce his capital account to zero, and anything after that will be income as uh, regular income. Okay, so in this case, what we're trying to determine is what is going to be the capital account of each partner. And so they have agreed to see here that although Jane has no physical assets to invest in the partnership, both John and Jeff believe that her experience as a real estate appraiser is a valuable skill needed for the partnership and is a basis for granting her a capital interest in the partnership. So what we're doing here is we're going to determine what the amounts are going to be as far as the capital accounts. And they're really not that difficult. So all we really do is we total up the assets, total up the liabilities. We look at the net assets. And since each partner is going to get a third, then 193,500 divided by 3 is 64,500. So now you've got 225,000 in assets, and now you've got 225,000 in liabilities. Now, the second problem, what they're doing is called Goodwill. So basically, they're saying record the partnership formation under the Goodwill method, all right? And so the Goodwill, of course, they've established to be 96,750. Same process, all right? So with the Goodwill at 96,750, we're looking at 321,750 for assets, still have liabilities at 31,500. That difference is 290,250. Divided by 3 is 96,750. So again, we have total assets of 321,750, and we have total liabilities of, well, that can't be right. Must be something. Oh, I forgot the 3150 here. Okay, so let's just pull this down. Move this 3150 over or 500 over. And now you can look to see that that is 321,750 down here. And that is 321,750. All right, 14.3. And so this is a problem. in a partnership, you can basically design many different ways to allocate income, allocate salaries, allocate capital interest, etc. And so this partner is set up with Jones, Silva, and Thompson to form a partnership and agree to allocate income equally after recognition of 10% interest on beginning capital balances and monthly salary allowances of 2,100 to Jones and 1,300 a month to Thompson. So depending upon their income level, this may cause them to have a loss, and whether it's income or loss, they have to share that equally. All right. So we can see that the capital accounts here are 43% to Jones, 26% to Silva, 31% to Thompson. So under the first scenario, we've got net income of 98,900. All right. So the first thing we're going to do is we're going to allocate 10% of the capital account. So that would be 4,300 for Jones. 10% of Silva would be 2,500. And Thompson, 10% would be 29,400. And so then we're going to take care of the salaries. All right. And Silva doesn't get a salary, but Jones, you can see, gets 27,600 based on, well, actually, this should be 2,100. Okay. And then this should be 1,300. All right, so we've got 25,200 that matches that salary, and we've got 15,600 that matches that salary. So now we get down to 50,270. So basically, what we have to now do is we have to split the remainder. Okay, so this is the difference between the net income and the total of what we've already paid out for the interest and the salary. And then we're going to split this evenly, the remainder evenly, the 48,630. So you can see that Jones is going to end up with the biggest chunk, and that's because of the salary and also because Jones has the highest capital. And so that's the situation in number one. Number two, we have net income of 38,900. And you can see that that's not going to be enough because that's going to be 50 to 70 again. And so that's lower. So we're going to end up with a small loss. And so they're going to have to share that equally, but they are guaranteed these payments. So the first part doesn't change. But again, you're going to look at the net income, which is going to be a net loss. And so that net loss is going to be spread evenly. And then in the last one, of course, it's even going to be worse. Although you can see Jones is going to do okay, but maybe Jones, again, contributed the most capital, and maybe Jones contributes the most work. So everything's the same up until this point. And then the difference was going to be just whatever the net income or the net loss, and that's going to be shared by all three. And then we've got this where Daniel Phoenix and Paul Tucson are partners in electrical repair business. Their respective capital balances are 90,200 and 50,000. All right, so you can see that here. Daniel owns 64%, Paul 36%. Because the partners are confronted with personal financial problems, they decided to admit a new partner to the partnership. After an extensive interviewing process, they elect to admit Mark Dallas into the partnership. So we're going to determine basically how much Dallas is going to get each time. So we have four situations here. The first one is that Mark acquires 1/4 of Daniel's capital. Okay. And so we're going to look at Daniel's capital, which is 90,200, and he's going to be giving up that much to Dallas. And so Dallas is going to pay him $28,000. But this really isn't a partnership. This is an individual issue. So what's going to happen really is that Dallas is going to report a $28,000 payment an expense of $22,500 on his personal income taxes. Number two, Mark acquires 1/5 of Daniel's. All right, so you can see here Daniel's 90,200 divided by 5, and also 1/5 of Tucson. So again, that's $10,000. So really, the credit to Dallas's capital account is going to be $2,840. It's not going to be what he paid. It's going to be what interest he has purchased from the partnerships. All right. Number three is Mark acquires a 1/5 capital interest for 61,200 cash investment in the partnership. Total capital after the admission to be 201,400. All right. So the difference here is that in the first two examples, he paid the partners directly. So that's going to be a personal issue with the partners where they are going to report a gain or a loss, most likely a gain, in these situations on their personal income taxes. But this is something that's going to the partnership. So Mark acquires 1/5 of the capital interest. All right. So he's giving them 61,200, and the total capital after the mission is 201,400. And so what's going to happen is that he is going to require 1/5 of 201,400. You can see here 201,400 divided by 5. And so that's going to be 40,000, but we've added 61,200 to the partnership. And so the remainder is going to be split between the two partners. Okay, so we've got the cash minus the 20% of the whole capital account of 200,400 divided by 2, and that's what each partner gets. And then the last one, Mark invests 40,280 for 1/5 interest in partnership capital. Implicit goodwill is to be recorded consistent with non-GAAP use of goodwill method for internal purposes. All right, so we've got cash of 4,200. We've got goodwill of 20,920. All right, and so goodwill, the total cap is 201. We have the capital that will be going, that is Phoenix. We've got the capital that is Tucson's, and we've got the capital that Dallas is buying. And so that leaves goodwill of 20,920. And so that goodwill has to be spread among among Phoenix and Tucson. So we've got 40,000, 40,000, and the goodwill, the other two partners will be getting the remainder there. And the last one is 14.2, and it's similar, except this is a situation where, okay, so Dave, Brian, and Paul are partners at a retail appliance store. The partnership was formed January 1st, 2024, with each partner investing 48,800. They agreed that profits and losses are to be shared as follows. Divide in the ratio of 40, 30, 30 if net income is not sufficient to cover salaries, bonus, and interest. A net loss is to be allocated equally. Net income is to be allocated as follows if net income is in excess of salaries, bonuses, and interest. Okay, so we have some criteria here, and we have to pay attention to this criteria. And so we'll have to pay attention to how much the partner or how much the partnership is making. So we have monthly salary allowances. Here's the monthly amount. And here's the yearly amount. All right, so let's move these to the middle, little bold here. Okay, so we have total salaries of 86,760. Brian is to receive a bonus of 8% of net income before subtracting salaries and interest, but after subtracting the bonus. Interest of 10% is allocated based on the beginning of year capital balances. Any remainder is to be allocated equally. So here is the operating performance, and other capital transitions were as follows. So the net income in 2024 was a loss. Net income in 2025 is 26,700, and the net income year end of 2026 is 122,850. All right, so the first thing we're going to do is we're going to allocate the okay, so here are the investment and the withdrawals for each of the partners for each of the years. All right. So we've got capital balances here of 48,800 for Dave. And he invested in 2024 an additional 15,800. So his capital account is now 64,600. Brian's started with 48,800. He invested 14,100. Paul started with 48,800 and he invested 6,100. So here are their capital accounts before anything else happens. Less withdrawals. So again, your capital account is reduced by any withdrawals and by a net loss allocation. So Dave withdrew 16,300. Brian withdrew 6,400. Paul withdrew 3,200, and they all shared the loss equally. Okay. Be allocated as follows if net income is in excess of salaries, bonus, and interest. It's not. All right. And then 2025, we go and there were no additional investments other than Paul. And then we have the net income allocation. All right. So that's 40% for Dave, and that's 30% for Brian, and that's also the same amount, 30%. So 40, 30, 30. Okay. Less withdrawals. All right. You can see those withdrawals 1630, 6400, 3200. So here's the capital account now. So again, you add that income allocations, you subtract that losses, and you subtract any withdrawals. And so here we're looking at 2026, and so 2026 was a good year, so we have to start taking all these other factors into account. So the only one that invested in the business was Paul this year. All right. So since we've got 87,600 in salaries, and since we've got income of 122,850, we can go ahead and allocate those salaries. And then the bonus, Brian is to receive a bonus of 8% of net income before subtracting salaries and interest, but after subtracting the bonus. All right. And so that's a little tricky. Okay. So that's B69. And that again is a calculation that you have to make where you're basically, so 0.8% times net income. Okay. Minus 0.8% to give you 9,100. So you need to kind of look at this formula. Bonus is equal to 0.8 times net income minus bonus. Bonus is 0.8 times 122,850 minus bonus. All right, so here you need to, again, is 0.8, that's the bonus amount, and that's dividing by that bonus amount. So dividing by the bonus amount, that's going to give you the net, okay? And in the interest, we have enough to pay interest. So then the residual is going to be these amounts here. So we paid the salaries, we paid the bonus, we paid the interest. And so now the residual is going to be 3440. So total income allocation. All right, so and the reason we do that equally is because any remainder is to be allocated equally. So we allocate that equally, total income allocation. So this is the total capital counts, and then we subtract the withdrawals. So these are the ending capital balances. So the trickiest part here is that you have to do this interactive type formula because it's a bonus paid in a funky way. And it's very similar to if a company is paying a bonus based on a certain level, and they also have to take into account that bonus. So these four problems are the main ones for the partnerships. Make sure you read the chapter on partnership. Again, it's not real difficult, but you just have to sort of go through the process.